Ryan, I'm smiling here. I love it. I mean, you've got three different companies. Well, so one is a driller, the other one is doing high
Yes.
tech in Saudi Arabia, and the third one is women's fashion. And yet, all of these are opportunities with, as you would say, great growth opportunities. And you're looking at the
Yeah.
numbers.
We follow the cash flow, right? And it allows you to build a very diverse portfolio. If you follow the cash flow and you buy the best businesses that are trading at reasonable prices in each segment, we're sector agnostic, you get a balanced out 20 to 25 stock portfolio. So I talked about the small caps today, but we also recommend, we cover every dividend stock in Canada to help you build that balanced portfolio. And we cover the Mag 7. We cover a ton of US
Well, good
stocks
morning.
as
It's
well.
Victor Adair, and I'm sitting in for Michael Campbell this week, and we've got a dynamic show lined up for you, and we're going to come out of the gate hot with Ryan Irvine. Ryan's from Key Stocks, and of course, if you've listened to Money Talks at any time over the last 25 or so years, you've heard Ryan many times. He focuses on particularly small cap value stocks. That's what I kind of think of when I think of Ryan over the years. Ryan, honestly, I've loved this guy since we met. When we meet at the different conferences and on the show here, we always kind of kid around and have fun with each other. But let me welcome Ryan to the show. Good to have you on.
And Victor, the feeling is mutual. We shoot barbs back and forth. I think we have been doing it for 25 years, but it's all in good fun. And hopefully we can have a little of that today. But you're right. We started in the small cap sector, look for growth at a reasonable price. So we're looking at value and growth, and really sector agnostic across all sectors. We're going to talk about three companies today that show that we don't care about the sector. We just care about the cash flow and earnings and the value in those
Yeah,
businesses.
I mean, that's one of the things I love about you. You don't care what the hell they do, just so long as they've got a good business model and they're making money and they got an opportunity to grow. But let me just frame something here. Like we both said small cap a couple of times. It doesn't mean that you're unaware of the macro picture. And right now, macro, I mean, the first two words in macro are Trump tariffs, and that's really
Yes.
important in the market. Give me like a quick take on your macro overlay and how that affects the way you look at your key business.
Yeah, and you're correct. I focus on the micro small caps for Keystone, but we build full 25 stock portfolios. Aaron looks at income stocks, and we have guys that look at the US too as well. But on the tariff front, I like to preface it by heading into 2025. We saw the markets kind of historically expensive, and we can get into valuations in a second. But as an analyst, these are really fun times in terms of tariffs. You're examining business structures, supply chains, where the goods originate from, what the exposure is for an individual company, but you're also looking at who can benefit. Not all of our losers in this scenario. We're looking at a couple, for example, US-based manufacturers right now that may benefit from this. And then you do all that analysis, and it can change in a day when the tariffs go on or off. Sometimes it seems like a whim. So fortunately, we do see markets kind of correct themselves. The sharply lower Canadian dollar, for example, is adjusted for some Canadian exporters. And we have to test these companies to see who has pricing power, who does not. If you have pricing power in this environment, we like that. If you don't, we're staying away. You have to be mindful of all of this change, but we do not stray again from our fundamental approach, looking at great businesses with strong balance sheets. Right now, balance sheets are really in focus. We love net cash companies because in weaker times or in uncertain times, they can have a fortress there that they can hold the business, but then they can power out of those times by buying other weaker businesses and grow. Basing an investment strategy on a sitting government policy is often folly. We could see change even in the US in midterm elections. We might not. But our focus is 5+ years when we look at any investment. So we're most often outlasting any sitting government. I'll give you an example of kind of folly of basing an investment strategy on a policy. Many Canadians this time last year sold because of the coming capital gains tax. They sold assets that they probably didn't want to sell. And then we see a flip-flop from the government, and now there is no capital gains tax. So you do have to look longer than a couple years out. But if you want to talk about valuations, we can talk about that, where we are today after a correction.
Yeah, well,
Should we talk about that?
I think valuations is a great idea from my macro perspective, looking at the stock market, and I trade it actively. It was hard to avoid the elephant in the room. The Magnificent Seven, or if you took the top 10 capitalized stocks on the S&P, they represented 40% of the market weight of the
massive influence. Massive.
So tell me about Mag 7 relative to the rest of the market, and like you, by the way, coming into 2025, I just kind of had that gut instinct that, man, we are priced for perfection here. There's a lot could go wrong.
Your gut is not wrong. Heading into this year, we were definitely priced for perfection. We used something, the Mag 7 was powering what we call the high in the Shiller PE. The Shiller PE is a cyclically adjusted PE. It gives you a broad idea of the broad valuations, and it massages out some of the fluctuations in earnings over time. The Shiller PE starting this year, it was at basically an all-time high. It's only been that high twice in its history. Today, after a correction, it's come down to about 35.1. That's still 30% higher than the 20-year average and about double the 100-year average. Now, it was within a stone's throw at the start of this year of its all-time 20-year high. Sorry, its 20-year high of 38.6. Again, it's only been there twice and been that expensive twice over the last 100 years. With that backdrop, it's really not surprising for us to see weakness given this uncertainty largely surrounding new, potentially more protectionist period that we're seeing. I don't think it's really potential at this point, but to be blunt, in the near term, the markets hate uncertainty, and the trade war creates uncertainty. We are a bit surprised that the market has not corrected further in some of the names. Now, that's not to say that there are not some opportunities here, but are we out there, say, aggressively buying auto parts manufacturers or steel makers? No. There are some select companies that we see value in today, but that's based on a fundamental cash flow basis, and that's looking at 5,000 to 10,000 stocks annually. We have a book of names right now, and some of those include the Mag 7, but we have a book of names right now that we're monitoring very closely, about 20 stocks, businesses that we really want to buy or want to buy more of in some cases, but they've been too expensive. So we're awaiting these quality businesses to drop, come on sale, come into attractive ranges. And I'm going to say, Victor, most people believe that you get rich in boom times. We see it very differently. You make your money in down markets, positioning yourself in great businesses that come on sale in sympathy with the overall market. Now you realize the fruits of that research or your label, you reap that harvest in their portfolio in a bull surge, but it is the work you do during the weaker times, uncertain economic times, that allows our clients or us to profit in good times. And that's what we're trying to do today. If you look at some great companies we want to buy great companies at a margin of safety. And in terms of finding a discount to their intrinsic value, you don't get that in normal economic conditions. This is both on the small and the large cap side. Like you said, we just did a review of the Magnificent Seven. The sell-off has placed some great tech businesses closer to on sale. They were very expensive, but have come closer to be on sale than they were in the past maybe decade. Amazon, for example, is a company we're monitoring closely. At one point last week, it was down 20% from its year highs, so that's in correction territory for sure. It trades at the lower end of its price to free cash flow multiple over the past 20 years, basically at its lowest rate, despite the fact that, like, you compare to the Mag 7, but also compare to a company like Costco. I think Costco is a wonderful business, but as bricks and mortar, it trades at 51 times forward earnings. Amazon you can buy now for 31 times. Costco certainly does not have the largest cloud business in the world like Amazon does. That is a very high margin business. So a company like Amazon and Alphabet, for example, both of them trade at historical lows on their price to earnings and price to cash flow basis. So they are becoming interesting. On the flip side, Tesla is the most expensive of the Mag 7 right now. So when we do the analysis there now, and this is not to say, I'm not saying I don't like Tesla or I love Amazon or anything like that. I'm just looking at the numbers and where they lead me. And do I see growth in these businesses going forward? Well, we've seen a slowdown in growth in Tesla. Earnings have actually accelerated in Amazon, and you're seeing a switch in terms of the multiples. Amazon's at its lowest, Tesla's at one of its higher multiples in the last 3 years. So these are where the numbers lead us. They lead us more towards the Alphabets and the Amazons. We're going to, in our upcoming webinars, we're going to review all of those and really drill down in about a 20-minute segment there where we see where the numbers are leading us and where we think the opportunities are in those Mag 7 that certainly drive the market.
Actually, let's talk about that webinar that you mentioned. I think you've got two coming up, April 3rd and April the 9th. You're going to be doing a webinar. Our listeners, the best thing to do here is to go to Mike's Money Talks, the website, for what we do here, and you can register for the webinar there. To come back to tariffs, I know actually, let's do it this way. We've only got a few minutes of, it's always a problem, but you're going to give us a little taste, as it were, here today of what you're going to do on the webinar. And I loved your highlight in the note you sent to me where you're trying to find some stocks that are not going to be hit one way or the other with the tariffs that are coming out. So what do you call that? Like tariff neutral or something? What's your term for that?
Yeah, we're saying tariff-proof stocks.
Tariff-proof,
Basically, tariff-proof stocks. We got a couple today that really are tariff-proof, and these fall into our category of that we'll talk about at the webinar too, of orphan stocks. These are stocks that are often smaller companies, kind of ignored by the investment community. They may be trading at low valuations measured against their current or future prospects. I'll give you an idea of how rare these stocks are. When we look at 5,000 to 10,000 stocks, we might find 2 to 5 on an annual basis. They have the potential to have lucrative profit element. Higher risk they are, but a lucrative profit potential in your portfolio. I'll give you an idea of the kind of magnitude of mispricing that we see in these stocks. We believe that they're 75 to 100% plus undervalued. That's why they're rare, and that's why there is higher risk, but the upside compensates you with that. Now, why would a stock be trading at 75 to 100% below its intrinsic value? Well, it's because it became orphaned for a number of reasons. They're not creating shareholder value. Minimal historic profits, weak margins, limited growth, declining businesses, poor business structure. Basically, the antithesis of everything that we look for in a great stock. So what changes this? What brings an orphan stock or what brings a terrible business into an orphan opportunity? Most often, there's some fundamental change in the business that dramatically alters the company's profitability equation, which is ultimately what drives a stock higher. Often, we'll wait until that catalyst comes into fold, until we see it to confirm our thesis, awaiting the release of, say, a quarter of results where we see good, solid growth, and then we'll step up and buy. That confirmation helps allay some of the what we call execution risks and prevents us from being stuck in an investment or concept stock. Now, there's no magic button to find these companies. It's just brute force volume. We have to look at 5,000 companies, like I said, to come up with 2 to 5. I can talk about a couple if you want to go into those businesses today.
Let's do that. Yeah, go ahead.
Okay. Yeah, let's talk. Orbit Garant is a company. This is what we call an absolute orphan. We started buying this company in January to start this year around 80 cents. It trades at $1.20. It's about a $46 million market cap. So that's a micro cap in Canada. They're based in Quebec, one of the largest Canadian-based mineral drilling companies, 188 drills that operate primarily in Canada and in Chile. Now, why do we like this business? Well, we like growth in revenues and earnings. EBITDA was up 460% in Q2. Earnings went from a loss to a profit of 4 cents in that quarter. For the first 6 months of this year, the company went from a loss last year to 12 cents in earnings. So trading at $1.20, you're trading at 10 times the 6-month earnings. But why do we like it? Again, the largest mineral-based drilling company in Canada, one of the it's orphaned in investing circles due to a spotty history of profitability and some higher debt that it's paying down. Poor profitability was largely due to its money-losing operations in Africa. So the catalyst here for this stock was that they pulled out of Africa and they focused on their profitable operations in Canada and Chile. 80% of the business is drilling for gold and copper. We know gold's at a record high. Copper is surging. The incentive for its clients, which are exploration and production companies, to drill remains high. Our investment thesis centers around them jumping to a higher level of earnings this year. We're already seeing that. We expect they'll earn 20 to 24 cents this year. That makes it trading right now roughly at 5 times earnings. Half of its peers. This is for investors with a high tolerance for risk. Again, we started buying in the 80-cent range. We think it's 75% undervalued right now, and it has the wind at its back for companies drilling for copper and gold over the next 12 to 24 months.
Okay, that's Orbit, and that's OGD on the TSX. And I guess you kind of think, Ryan, that if you're sort of bullish, here comes a bull market in commodities, this might be a stock that would fit in that portfolio.
It's a picks and shovels way of playing a commodities boom, and there's already a boom right now, and you're buying it at a discount to peers. So we like that.
Good. Yep. You got another one?
The next orphan stock, NTG Clarity Networks, NCI. We were able to buy this company mid last year, about the 80 cent to dollar. It's $1.73. So you say it's doubled. Why would we like to buy it? Well, earnings and cash flow have gone up far more than double. So they are a Canadian company, provide digital transformation, software development, IT services, but in the Kingdom of Saudi Arabia. Now, why do we like it? Tremendous growth in revenues. 109% growth in revenues in the last quarter, up to 14.7 million. Net income was up 303%. So the stock is up 100+%, but net income is up 300%. We like that. Why do we like it? Powered by a $1.3 trillion investment in technology by the Kingdom of Saudi Arabia, a massive digital transformation. NTG's investment in this region is paying off. Impressive revenue growth recent years, exponential growth in contract sizes. Overall revenues have nearly risen 5-fold from 2001 to 2024. Recent quarters, about 100% gains in terms of revenue. Parallel that with a backlog that has surged over the past 12 months. They had 20 million in backlog 12 months ago. Now it's 105 million today. So backlog is rising. Again, the stock is up over 100% in the last year, but it still trades at 8 times earnings. And we're looking at 35 to 40% growth this year. We view it as an underfollowed growth at a reasonable price, small cap, beneficial cost structure through its massive digital push in Saudi Arabia, low cost workers in Egypt, and it is operating outside tariffs right now. So we like that. Kind of a tariff-proof
stock. And what's that? The name again?
The company is NTG Clarity. The symbol is NCI on the TSX.
Okay,
Venture.
Super. We got a couple of minutes. You got one more for us?
We got one more. Now, this company has kind of moved lower as it has some exposure to tariffs. But the last time Trump introduced tariffs, this company was able to raise its prices and actually made a better margin. So we think the street is underestimating the story. The company's Group Dynamite, if I can say it, Inc., GRGD on the TSX, $14.20, and around that range, $14. $1.5 billion market cap. Doesn't have a yield, but we expect it could implement a dividend over the course of this year. Just listed on the TSX in November, so relatively new, and we think it's unknown. They are a growing women's fashion retailer, about 299 stores across Canada and the U.S., about over 50% in the U.S., which is what we like. Revenues in the last quarter up 18%, which is good to see. Same store sales growth up 10%. That is high for a company of in this segment. And we saw net income rose 16%. EPS was up to 38 cents from 32. So growth in the earnings like we like to see, but they are an agile company, growing fashion retailer with a superb balance sheet. Midway through this year, it'll be significant net cash. They recently IPO'd. So they IPO'd to the market at about 21. You can buy it under 14 today. It trades at about 11.5 times earnings. That compared to peers. I'll give you a story quickly. 6 years ago, about today, we recommended a company called Aritzia. It's gone from 16 to 54. It trades at about 35 times earnings. You can buy Group Dynamite. It's not the same type of company, but similar women's fashion retail at about 11 times. So you're buying it at less than a third of the multiple with similar growth rates. We like growth at a reasonable price. We like both those businesses, but Group Dynamite is cheaper today. So that's why we like it.
Ryan, I'm smiling here. I love it. I mean, you've got three different companies. So one is a driller, the other one is doing high tech in Saudi Arabia, and the third one is women's fashion. And yet, all of these are opportunities with, as you would say, great growth opportunities. And you're looking at the numbers.
Yeah. We follow the cash flow, right? And it allows you to build a very diverse portfolio. If you follow the cash flow and you buy the best businesses that are trading at reasonable prices in each segment, we're sector agnostic, you get a balanced out 20 to 25 stock portfolio. So I talked about the small caps today, but we also recommend, we cover every dividend stock in Canada to help you build that balanced portfolio. And we cover the Mag 7. We cover a ton of US stocks as well. But the cash flow leads us to that. It makes our job very interesting because we're not just focused on one sector. We get to interview CEOs from amazing businesses across all sectors, and it gets our clients exposed to some really unique companies in all those segments. So I'm glad you pointed out that they're completely disparate businesses, because not all people figure that out. So it's good to see.
I tell you what, folks, I think this is what Warren Buffett sounded like back in the 1930s or something.
You know what? Warren made most of his fortune after 50. You know what? I'm going to start to do that in Canada today. That's our plan.
Okay.
Right?
Listen, Ryan, that was super. You're giving us a taste here of what you hope to do on the webinars that are coming up. People that want to find out more about Ryan, and I'll just give him 100% thumbs up personally. I like him, even though we do kind of poke at each other and have fun doing it. April 3rd and April 9th. Yeah. The webinars, go to mikesmoneytalks.ca and get more information. And there you go. Ryan, thanks for being on the show. And it's it's fun to see you again.
It is great to see you. And we'd love to see anybody at those webinars help you build that simple 20 to 25 stock portfolio. Great to talk to you, Victor. Have a great day.
Okay, you too. Thanks, buddy.